paying less tax with pensions. There are three main ways that normal people like you and I save money in the tax system. One of them's R&D tax credits, if you do lots of research in your business. One of them is making sure you use family members' tax allowances, and one of them is pensions. And today I want to talk about pensions. So why are pensions so good for saving tax? Well, there are a number of huge benefits that the pension system has at the moment. The main thing is that you can earn money which might be taxed at 40% if you were just taxed on it as income. You can put that into your pension, and at that moment it's not taxed at all. Now, for a lot of people, they actually pay tax at about 45%. So you've got a choice. You can have £5,500 in your pocket or £10,000 in your pension scheme. And having £10,000 in your pension scheme is really good. The advantage then is that hopefully, or maybe when you're retired, you're a basic rate taxpayer, so you're only going to pay 20% tax at that time. But the benefits don't stop there. No. As the rules are now, you get 25% tax-free lump sum, so 25% of what you put into your pension is never taxed. That's amazing. And the pension scheme sort of works like a family trust fund, and I'll go into that a little bit later. So that sounds almost too good to be true. So what's the catch? Well, there isn't really a catch as such. It is really good, and I think that the benefits are so good that the system wouldn't be invented if they were going to start from scratch again now. So it's almost like an anachronism that the rules are so generous to people. But within that context, the government has changed the rules fairly recently and made them a lot better. Obviously, if they can change them in one direction, they can make them worse in the future as well. So that just needs to be borne in mind. And once you put money into a pension scheme, it's never quite yours again because it's in a trust and it's not directly owned by you. And you have to wait until you're 55 or perhaps a little bit older before you can touch your pension. So for me, that's not too big a problem because I'm pretty close to being 55. But if you're only 20 or 30s, then that's actually a much bigger problem because you've probably got other financial thoughts like buying a house, bringing up a family that you want to do. So putting money into a pension is not perhaps the same priority as it is for me. So why do I say that having a pension is a bit like having a family trust fund? Well, if I put money into my pension scheme and just leave it there, and if I was to die before I was 75, that would be amazing because that money would never be taxed. And I'll be sat there in my casket laughing at the tax man because I'd have put money in, get 45% tax relief and never pay that tax. Amazing. Obviously, there is a disadvantage to that I have to pay the ultimate price for that tax saving. However, that money would directly go to my heirs and never be taxed. It wouldn't be part of my estate for inheritance tax. That is really good tax relief. Similarly, if I'm older than 75 or there's one or two other rules, then it may be that my kids and my wife will be able to take an income from the pension and that'll be taxed. But still, it'll be taxed as income, which it would always have been, but it won't form part of my estate for inheritance tax. So in terms of your family, I can control the money in my pension scheme. I can draw it down whenever I like, but then if I don't need it, I can pass it on to my heirs without paying inheritance tax. And that's like what everybody wants from inheritance tax planning. So a family trust fund, if you think of it as that rather than as a pension scheme, I think that sort of helps get you over the hurdle to some extent. And the tax benefits are really, really good. So what sort of pension schemes can you have? I mean, if you work for the government or for a very large company, there are still one or two final salary pension schemes, but not really very many. Big companies have pension schemes where they look after the money. And they can be great because often they're very generous and they make some of the contributions for you. Or you can have a personal pension or a pension for a group of people, because I quite like the idea of having a pension for a group of people who work in a business, because that allows you to pool your assets and say buy a commercial property or something like that. I think having a pension scheme which is either personal or for a group of you, where you can control what it's invested in and you can control how to take the money, I think is a marvellous thing to be able to do, and it's certainly something that I've taken advantage of. So what are the rules? How much can you put into your pension scheme? Well, generally you can put £40,000 a year in and you can backdate it, but it is limited if you're a higher earner. You can put up to just over £1 million into your pension scheme in total before there's adverse tax effects. And the limits for putting money into your pension scheme are for each year. So that's either the year of your company. So if you have a company, then the key date is your company year end. You have to get that money into the pension before your company year end to take advantage of it. So that's really worth taking care to make sure that you do make the payments in time. Or if you want it to affect your personal tax, then the 5th of April deadline is important. So make your pension payments before the 5th of April. If you'd like help deciding if you want to make pension payments, how pensions could work for you, and how you can save tax, then please get in touch. I'd love to hear from you. If you like this video, please like, comment, share, press the bell button so you can see future videos, all that sort of thing. That really helps me. Thank you.